and author of the Blueprint, and I'm joined today by my good buddy Mike Chupka. Say hello, Mike.
Hello, everyone. It's good to see you here. Kurt, I assume things are going well for you out there in Colorado?
They are. It's nice and sunny, and guess what's going on? My daughter, my oldest, is 20 and in the Air Force, and she and her husband are expecting, and I just got a call, and we're in contractions. We're in labor.
Whoa.
So I may have to stop. I may have to get off this webinar. No, I think we'll be able to finish it, but I am eagerly sitting by the phone. So, well, gosh, I'd like to welcome everybody today. We've got a pretty good crowd. I see at least one fellow Blues Brothers fan out there. Somebody signed in as Jake Elwood. Hello, Jake. Good for you. Let's see. We've got, I'd like to welcome Randy, Richard, Robert. We got a lot of doubles. Okay, I'd like to welcome Sam and Ted and Terrell, Walter and Wayne, Joseph, 3 Chucks, no less than 4 Bills. Good to see you guys, Davids. All right. Well, we're going to go ahead and get rolling, but what I want to do real quick here, Mike, was just a warm-up poll. And the reason for the polls is so that we can get the most out of this program, okay? All right, and what I thought I would do is start off with this poll just to kind of test a little bit of your options trading knowledge and also maybe do a little bit of a trick on you, okay? So here's the deal. I'm launching it. You've got 10 contracts of QQQ $55 calls, cost you $275, and you've also got 10 contracts of QQQ $60 puts, cost you $275. So we get $335 and $275. That's the deal. So what's the most that you could lose with this trade? What's the most that you could lose with this trade? Let's go ahead and look at it carefully. How much we have at risk and how many contracts there are, and there's 5 possible answers. $6.10. Oh, that's kind of interesting, Mike. Yeah, we're having we're not having a whole lot vote. Oh, okay, good. Now it's starting to roll in. Good. So $6,100. Say a lot of folks. $610. Say a lot of folks. We've actually got some folks saying you cannot lose with this trade, and we do have trades like that. We do have trades like that that you can't lose with. I'm not going to say whether or not this one is one of them. So far, nobody has said $6.10. Do I have any takers there? Nobody's going to say that? Okay. We've got representatives in 4 of the others. So, all right, Mike, I'm going to go ahead and close that poll and share the results and see what we've got here. So nobody said $6.10. 38% said $610. 6% said you cannot lose with this trade. 13% got the correct answer, which is $1,100. And 44% said $6,100. So I think what happened there was perhaps what happened with me when I first saw this example, when I first saw this kind of example, I just added the risks together. You know, you get the risk of $335 on one and $275 on another, so it must be a total risk of $610. You know, times 10 contracts, it must be $6,100, and that's what a lot of folks do. And in second place, we got some folks that did the same thing, but they ignored the 10 contracts, so they said $610. Mike, why is that correct answer only $1,100?
Well, because both of if the stock's trading right around, let's say 57.5, both the call and the put are still in the money by $250. So you don't realize the full risk of the position if you added everything together.
Right. Right here I've got that position graphed. It's actually, what would you call this, Mike? A straddle, a strangle?
It's a little different. The term I use for it is sort of an in-the-money long strangle. And I say in the money because a lot of times long strangles are described as doing sort of the opposite. You buy the 60 call and you buy the 55 put, so both are out of the money at the time of entry. And you showed an example where both securities would have intrinsic value if the stock was trading right at 57.5, for example, because you'd still have an in-the-money put at that time and an in-the-money call, so you wouldn't lose the full amount of the investment. So we refer to this as an in-the-money long strangle. Different strikes, long both, but they happen to be in the money.
Very good. Okay. All right. So, and the thing is, I got caught by that one too, and I just wanted to see how sharp we all were, and it looks like 13% of us picked it up. So, I don't feel too badly. but now, of course, Mike, we look at options spread positions a lot differently than we used to. You know, when you first saw my position, the radioactive profit machine, you looked at it and said, well, geez, I don't see how you can make any money with that. And that's a knee-jerk reaction that a lot of folks have.
Right.
So, Mike, I'm going to just do a brief introduction for myself here in a moment. Can we have an introduction for you? And then I'm going to recommend to everybody that you participate in the polls and the prompts. Save questions for breaks. We have 3 scheduled breaks, okay? And if you save your questions for then, it'll be a little easier on Mike, because Mike is usually operating the keyboard and reading the questions off, and I'm usually yapping, although we both do a little bit of both. Mike, how'd you come to be involved with radioactive trading? You're not well, you are a radioactive trader, but you weren't part of the company when it was founded. But what's your relationship to radioactive trading?
Yes, well, I'm the Director of Education here at Power Options, and Power Options is a patented suite of search and analysis tools designed for self-directed options investors. We support over 23 different strategies. We have a lot of education on the site as well, and of course I handle a lot of coaching sessions, and I've co-authored a couple of books with Ernie, the president and founder of Power Options. I've been with Power Options for about 9 years now, and about 3 years ago, 3 years and maybe 3 years and 4 months now, one of my customers called up and wanted some help with the back testing tools to evaluate a certain type of setup on a married put position, and I walked the customer how he could do that, how he could evaluate the positions. But as I normally like to comment, when I see something that looks out of place based on my experience and my education, I pointed out that, well, I understand that you're limiting your risk to single digits. That's great, that's good to see, but at the same time, I don't see how you're going to make any money. You're increasing your cost basis so much into this position by doing it the opposite, in a sense, of the preferred method that's taught and educated at different brokers and common options knowledge. And I was concerned, of course, for my customers. I always am when I see positions that look a little bit different. And of course the customer said, well, let me show you how I make money. And of course that customer was Kurt. And I joined his free webinar, just like many of you are doing right now, and was impressed with the techniques and what he was doing, and I told Ernie about it and had him join me. Ernie's been trading options for about 25 years, and Ernie was so impressed with the technique that we decided to partner up with Kurt and enhance our tools on Power Options and the married put search, the married put analysis, the married put features, as well as the portfolio tool, so that people following this technique had a perfect set of tools to identify those positions that match the basic criteria or their own criteria for their risk threshold, and use the portfolio tools as well to help them track and manage the position. Now, Kurt, we did have a question that came in at the very beginning of the presentation, and I answered this one, but I'm going to take the chat board here, and I'm going to send everyone a link. We'll get this out of the way first. And the customer wanted to know, he's over in the UK there, and he wanted to know what is having trouble trying to find positions, what is the preferred delta to use to find these risks of 4%, 5%, and 6% on these married put positions? And how can you find it on e-option? And I replied to the customers that, well, it can vary. There is no one answer on the delta question, because some stocks that have a higher volatility, you'll have to go deeper in the money, find a higher delta in order to find that at-risk amount. And some of the stocks that have a lower volatility, which still might be good opportunities, you won't have to go as deep in the money. You won't need as high of a delta to have that. But the real answer is that the tools on Power Options, and everyone can get, if you don't already have it or if you haven't already taken advantage of it, you can get 2 free weeks of Power Options by going to www.powerop.com/RAT, and you can test it out for 2 full weeks. And that search tool greatly simplifies it. So rather than trying to focus on what delta, what implied volatility to use, what historical volatility to use, and so forth, then you can just put in your at-risk amount and what you want to see in percentage-wise. I only want to see the married puts that have 5 or 6%, and in an instant you have those results. Just those results out of all 3,200 optionable stocks and ETFs and indexes that match the criteria. You'll see only those ones that match what you're looking for.
Cool. Mike, of course you work for Power Options, but you know, I've had experience with Power Options as a customer, and I've always been pleased. But you actually trade these kinds of issues yourself, right?
That is correct. I've been trading radioactively for about 3 years. About 60 to 65% of my invested capital at any time is into radioactive profit machines, and I also do some standard collars as well.
Right. And a standard collar is similar in some respects to a radioactive profit machine because the basis of it is a married put. So, very good. Well, I'll tell you what, folks, this is going to be a great webinar. What I wanted to do is find out a little bit more about your options trading experience, what you're doing. And so we're going to launch a second poll. And then I'm going to go very briefly through my story. Very briefly, and then we're going to get into some meat and potatoes. Now, just a warning, a caveat. At one point during the presentation, I'm going to talk about my book. Okay, and yeah, that's what pays the bills. But I'll tell you that 95% of this presentation is going to be educational, and we're going to give you some usable techniques right off the bat. An incredible setup technique that's helping folks all over the world stop losing money, and then 3 riskless spread trades that are helping folks to take money out of their positions without necessarily selling them, and leaving the upside open, kind of doing the opposite of what covered calls do. Okay, Mike, we've got most of our votes in. I'm going to leave it up for another few seconds. Nobody has said options me no likey, so far at least, and it looks like we've got about half of the audience doing covered calls. That figure is falling just a little bit. Winner so far is spread trades, and that's great because the spread trades I'm going to be showing are riskless spreads, which sounds pretty fantastic, but it is true. Okay, Mike. So we've got nobody said options me no likey, 50% covered calls and naked puts, 61% long calls and puts, and our winner is spread trades. 63% of the audience is doing it. 3% are doing naked calls. That's a little sophisticated for me. I am cleared to do naked calls, but I don't participate in that just because it doesn't fit my risk-reward profile. Okay, so Mike, do you see where it says the beginning?
We are at the beginning, origins of radioactive trading.
Origins. Let me blast through this fast, okay? Here's the deal. I went to one of these weekend seminars where I learned how to do cover calls trading, Mike. They also taught some spread trades, you know, bull call spread, bull put spread, bear call spread, and calendar spreads. And I thought, wow, you know, this is cool. I learned everything I need to know about trading on a weekend, right?
Right.
he said tongue in cheek. And anyway, I did pretty good with covered calls for a while, and also with long calls. Did all right, and I got into a stock called Lipo, which is now no longer existent. But at the time, it was trading at $17 a share, and the $20 calls six weeks away were selling for $3. Okay.
Okay.
Now, Mike, I had learned about trading. I learned the mechanics. I learned how to set up a trade. I knew a little bit about how to do things, but I didn't know a whole lot about why I should or shouldn't, and I didn't know anything about what, you know, as far as how much of my account I should put at risk. I didn't understand a lot of things, and I ended up getting hurt. In fact, I lost my whole life savings. The cover calls seminar cost me over $3,000, and the stock timing software that I was using cost $3,500. And then the market cost me my life savings. Okay, so that was not cool. But I realized that it was not because of bad luck. It was not because of you know, the man or somebody you know, taking advantage of me. What it was about my behavior and what I did. And Mike, I just started paper trading almost immediately. Started paper trading, and I said, you know, what if I just did everything that I did do, only did it backwards? How about instead of selling a call and mixing that with my long stock position, how about I buy a put for insurance? And instead of selling a front month call how about that put that I buy is far out in time? For example, a 1 month out put and a 6 month out put. The 6 month out put does not cost 6 times as much, does it?
No, no, it does not. That's the way that options are priced. It's almost like when you buy insurance for your car. If you pay month by month by month, let's say you pay $100 per month, over the year you'll pay $1,200. But if you tell them you want to pay 6 months out, they might give you a little bit of discount. So you will maybe pay $550 every 6 months, so your total over the year would be $1,100. And if you want to pay the full year up front, they might only have you pay, let's say, $1,000. So you're saving $200 off the total cost. And options work the same way.
Right, options work the same way, only a little bit better.
Mm-hmm.
Instead of selling an out of the money call, I thought, why don't I buy an in the money put? And especially, what about just not using margin anymore?
Mm-hmm.
Using margin is what got me into trouble. Trying to leverage my returns too much is what got me into trouble. And this is what this turned into. It turned into trading with a net. You see, Mike, I bought my 3-year-old. She's now 20. She's going to have a baby soon. Okay, but when she was 3, I bought her a trampoline. And maybe that's not the most responsible thing, folks out there that are parents are probably shaking their heads. But then again, I am a martial arts instructor. It's what I do. I raised my kids to have no fear. Mm-hmm. And Jade is an excellent gymnast and dancer. And anyway, she was on that trampoline, and so was I, and we were taking turns. I did a front flip. She thought that was great. She did a little tumble type thingy. And then she said, "Daddy, do a backflip." I said, "Okay." And I jumped up and tucked my knees to my chest and looked back, and I thought, wait a minute. I'm not sure if I know how to do a backflip. Now, this was 17 years ago, but point is, Mike, my body had the ability to do the backflip, but my mind wasn't quite ready. And I ended up getting hurt. I kind of came undone and bounced off of the tramp and hit my chin. It was a bad scene. But not long after that, I saw a contraption kind of like this. Do you see this deal with the columns raising up on each side?
Yes. Mm-hmm.
It was actually a sturdier setup than what we're looking at here. It had this harness coming in and taking the wearer and making it so that they could not possibly wipe out. It couldn't possibly go down far enough to they could hit the trampoline. They could touch the trampoline, but they could never hit it hard and get hurt. And Mike, I got into this thing, and I found out that I could do triple backflip, mm-hmm. land, and push off with my feet, and then do a double front flip. You see, not having any fear released the high performer within. And it was after this that I thought, man, why don't I think about applying that to trading? And here's what happened after getting cleaned out. By the time I got divorced, sometime after that deal, and the life savings were gone, and and after the divorce, a lot of funds were gone. But by October 1st, 2002, I had put together about $2,500, and I still had a margin account. Here's what happened: I invested $2,499, and for the commissions. For the stock commission was $7. The option commission was $7. I actually had to margin that, but that's okay. I was okay borrowing $14. Okay, I was all right with that, or $13, whatever it is here. Mm-hmm. All right, but I took my $2,500. I put it into a stock plus a put option that was far out in time. If you'll notice, this was October of 2002, but this is January 2005 put option. So I did this. I bought in the money and went far out in time, and $4.99 was at risk. Now nowadays I would never take 20% risk like this.
Right.
Okay? But this is what happened. Amazon over the next 13 months nearly quadrupled, and there was still some time left in that put option. Now, Mike, if I had bought Amazon at $16.09 and sold the $17.50 call, I would have made money, right?
Yeah, you would have kept the premium, and you would have gotten some of the capital appreciation from the stock price to the 17.5 assignment strike.
Right, but I would have missed the big picture. You see, I would have felt like a chump because instead of making 5% in a month or something, I would have missed out on 200% in a year.
Mm-hmm.
You know, or is that close to 300? Well, it's a pile of money. Did a lot better this way than by using a covered call. Now, we've already run this poll, Mike, what options strategies are folks doing. And right now, we've got 50% of our audience using covered calls. So a little bit later on, we're going to take a baseline reading. We're going to say, hey, you know, how happy are you with your trading? But just before we get there, I want everybody to feel a little bit better because here's the deal. Look this up sometime on the internet. Coach Ralph Vince gave 40 PhDs a virtual $1,000. Now, Mike, PhD means piled higher and deeper, right? Well, that's what some of my PhD friends say, you know. But the fact is that these guys are no slouches intellectually. Okay, they had some brains. But they were given a game that had 100 trials, right, and 60 guaranteed wins. Although they were random, you didn't know when the wins would come. There was going to be 60% wins. Okay?
Mm-hmm.
There's going to be even money returns. So if you bet $1, you'd get your dollar back, and plus you'd win $1, right? Or if you bet $200 and you won, you'd get your $200 back plus the $200 win. Okay, so it's even money return. And they had free rein as to how much to bet. Now, here's where they got into trouble. Would you believe that out of the 40 PhDs, 38 lost money in a very beatable game? That's 95%. Yeah, that's 95%. You know, if you had, you know, oh gosh, 95%. You know, so only 5% actually made money with this. Okay, so what happened? Well, they were given, like I said, free rein as far as how much to bet. How much to bet. And by the way, they were all playing the exact same wins and losses. It's like they were all in the same market at the same time. And sometimes, Mike, folks that are in the same market at the same time can make the same buy decisions, right? And end up one of them loses money and the other makes money, and it's kind of weird, but that's how it is. Okay, so in a game with 100 trials, and 60% of those trials they're guaranteed to win. All they had to do was bet $100. How likely is it with a 60% win likelihood? How likely is it that there would be 10 losses in a row?
Well, it's possible, isn't it?
It could happen. You know,
it's not necessarily likely, but it is possible.
It's possible, but you know that likelihood is very, very low. Okay, that they'd have 10 losses in a row. So, so with $100 bet, you know, if they bet $1,000, okay, would that be a good way to go?
No.
No, because you got a 40% chance on your first try of losing everything, right? What if they bet $1? Would that be a good way to go?
I don't know. Well, you might be putting too little in. You know, size does matter. You can tell me, Kurt, that you made 100% on your trade, your last trade, and I'd say, great, Kurt, that's excellent. How much did you invest? You told me you invested $1. Oh. Okay?
Oh, okay. So now you have $2 minus commissions. You're in the hole. You know, not cool. All right. So, but you know, if they were to bet $100, here's how that would end up. There would be 60 wins out of that 100 trials, right? Which would equal $6,000, and there would be 40 losses in that 100 trials because it was guaranteed to go this way, right? Okay, so starting with $1,000, somebody with this kind of game in front of them should have made $2,000. You know, with just a controlled bet like that. If they bet too much, they could lose, and if they bet too little, they would not win very much. Okay, you know. 60 wins times $1, for example, minus 40 losses times $1 would be only $20 if they bet $1 a trade. Okay, so the point is, Mike, we've got a beatable game, and they still lost.
Yeah.
They still lost. And I'm going to say that the stock market is a beatable game, but most folks don't set it up that way. Most folks are on the wrong side of this Martingale deal here. Okay, gambler's ruin. If you look here to the right, you know, if you lose 10% of your trading account, Mike, do you need to make 10% again to get back to where you started?
Well, if I lose 10%, I need about an 11% gain to get back to break even, don't I, Kurt?
Right. You see, if we had $100,000 and lost 10%, then that'd be $10,000 gone. And then we've got $90,000 left to work with. If we make 10% on our 90,000, that's going to be another 9. So 90 plus 9 equals 99,000. So if we lose 10%, then we make 10%. Look, we're behind by $1,000. Okay, and it gets worse. It gets exponentially worse. You know, 20% loss means you need a 25% gain. A 25% loss means you need a 33% gain. A 33% loss means you need a 50% gain. A 50% loss means you need a 100% gain, and that's just to get back to where you started. Now, up and to the right, that exponential curve is working against us. And folks that want to quote-unquote preserve capital, meaning that they don't have a whole lot to trade and so they want to really leverage themselves with what they do have, they're going to get bit by that. Okay, this is why 8 out of 10 people that play the stock market end up disappointed. 8 out of 10. Okay, folks that are trying to use leverage will get hurt eventually. Okay, but down and to the left, it's not such a slippery slope. If a 50% loss means that I need a 100% gain to get back to full strength, you know, if I lose half my account, I need to double what I have left to get back where I started. If I lose a 5%, does that mean that I need to win 10% on my next trade?
No. If we suffer a 5% loss on a position, we typically only need about a 5.3, 5.26% gain to get back to break even.
That's right. Okay, and that's easier to see, right? That's easier to do.
Yeah, it's more expected in the market, sure.
Yeah, you know, winning 5.26%, I could see doing that. Doubling my money, that's going to take some work. And that's going to take a lot of luck too. Okay, so here's the problem with trading. We just don't know what's going to happen next, and we will have losses. We're going to have strings of losses, and we're going to also have strings of wins, and it's inevitable. Now, here's the deal. Since we are going to have strings of losses, we need to keep those losses as low as possible. And since we are going to have strings of wins, we want to be as fully invested as it's prudent to be when we've got those wins coming. Okay? So let's go ahead and take that baseline reading, okay? I'm going to go ahead and ask, whoops, wrong one. I'm going to ask, out of those different trading results, okay, are you happy? How happy are you with your 12 months performance? Answers range from yes, I'm super happy. I made piles of money in 2010. I'm doing well in 2011 so far. Maybe I'm happy, but I could stand to be happier. Maybe it's mixed emotions. You know, you've won some, but you've also lost some, and that's cut into the wins, and you know, not as fun as it could be. Maybe you're unhappy with your trading. In honor of my radio producer one time told me, Kurt, I'd rather take a physical beating
right.
than a beating in the market. Or gosh, you know, would you say your results sucked? Now, Mike, almost always we get the bell curve here. You know, we get very few folks on the positive side, very few folks on the negative side, and most everybody else is stuck in the middle. It's looking about the same. Let me go ahead and close that poll and share the results. So, Mike, we had 5% say that they were very happy. 27%, I'm happy but can stand to be happier. So that's a total of 32%. That's actually high. You know, usually those first two add up to a total of 20.
On average, yeah.
Yeah, so that's kind of high for this group, and that's good. I still would like to see it higher. 32% say mixed emotions. I've won some but lost some. 27% not so good, and 8% really not so good. So I'm going to say that 68%, 7 out of 10, about 7 out of 10 of our audience could really use something to fix what's going on. You know, and then 27%, you know, they're happy, but they could stand to be happier. So let's explore that. Let's get into that. Okay. What I'm going to do is I'm going to show how to solve the biggest problem first. Okay. Solving the biggest problem. You know, I've been asking this as a poll, and I just decided, you know, week before last, I decided to quit asking it because what always wins here, Mike? If we say what one thing would you like for me to do for you? If I could wave a magic wand and we could solve this problem for you, either we could give you more time to trade, more time in your day to trade, or we could give you bigger wins, or we could help you become an expert at trade timing or stock picking. Almost everybody says that this one thing is more desirable than the others. What is it?
Well, every time we ask the poll, the answer always comes up. The winner, the majority is, I'm okay taking losses as long as I can control those to single digits, so I can control my losses. That would make me a more successful trader.
That's right. You see, we usually get representatives in all five categories, but the highest answered category is controlling losses. I just like to know how to control losses. Okay, and rule number one, as Warren Buffett always says, is don't lose. Rule number one, don't lose. Rule number two, refer back to rule number one. The reason that you're going to have the capital to catch those runaway winners is that you haven't lost too much on the losers. Mike, last year you had a trade that at the beginning it couldn't possibly have lost more than 7%, right?
That's correct, yes.
Okay. A month in, it was bulletproof, which means that you had adjusted it to a place where it couldn't lose at all, right?
Yeah, my protection, my insurance policy that was a guaranteed exit was greater than my cost basis.
Right. So 7% maximum loss at first. A month later, can't lose. And then 6 months later, you closed out the trade for 59.8% gain.
Mm-hmm.
Now, that is impressive. That is super impressive, to be honest. But if you had lost half your account before that, would it be as impressive?
Well, no, and assuming that I was invested entirely into the position with my remaining account, if I had lost 50%, I was going to need 100% gain on that position and be fully invested in it in order to get back to break even.
Right. Okay. But in fact, you did have some losers last year.
I did.
But of those losers, you did not have a serious damage to your account, right?
That's correct. I mean, at any time, if I lost on a position, the max I would lose would maybe only be 4, 5, or 6% on the position.
Right. So I'm going to introduce this concept here, forcing ideal-sized trades. Forcing an ideal-sized trade. If you bet too much, you can get hurt. If you bet too little, you can't gain very well. Okay. There is in between an exact amount that makes the most sense to risk. And I'm going to say that we found that. We figured out how to do it. Mike, I'm going to need to sign out here for just a moment. Can you take our audience through the Trade Simulator tool on RadioActiveTrading.com?
Yes,
Yeah?
one moment.
Okay.
Hold on.
You betcha.
Okay. Just get in here. I apologize, ladies and gentlemen. Let's just do this here, and I'm going to make myself the presenter. Hold on 1 second. All right. Now, whoops. I'm looking at the wrong screen. I apologize. That's much better. Okay, ladies and gentlemen. What we're looking at now, we're at RadioActiveTrading.com. We're going to go into the Resources tab here at the top of RadioActiveTrading.com. And if we scroll down on the Resources tab, we're going to click on the Trade Simulator tool. Now, what the Trade Simulator tool is doing is it's not giving you any type of guarantee of what you should expect to make or shouldn't expect to make with a specific win-loss ratio with a set target return and a set loss limit. It's a projection of what's possible. Now let's take a look at this first scenario that we have available. Let me grab the arrow here so we can point this out. Well, this tool we started out with is we're taking a portfolio. Let's assume we have $10,000 sitting in a portfolio. We're going to follow a certain trading strategy. And in this trading strategy, when we're right, we're going to close the position when we make 10% on our investment. And when we're wrong, we're going to set a stop loss so we close out of the position if we have a 10% loss. We're going to assume the stop loss is guaranteed, which we all know it isn't, but for this we're going to do that assumption. So we're going to make 10% when we're right. We're only going to lose 10% when we're wrong. And we're going to assume a probability of gain or loss of 50%. In other words, we're going to flip a coin 100 times. Heads, we make 10% on this strategy. Tails, we lose 10% on this strategy. And then down below, we have the simulation results. Now, in this first result setting, it's not too good.
I just want to let you know I'm back, so I can
Okay.
I can participate with you. But go ahead. So we've got 100 trials, and
So in our
summary
first,
is to the left.
this first basic result that came up shows us that over those 100 trades, we were right 48% of the time, and we were wrong 52% of the time. Now, at one point, we might have thought we had a winning record. We took the account up to about $13,923 from our original investment of $10,000. But at the end, after 100 trades, and of course we were wrong more often than right, we ended up down almost about, 76%, and the ending amount was about a 60% loss. So that's not a way to be successful. But what we commonly say is, let's go ahead, we just need to be right more often than wrong in order to make money. So let's go ahead and run the simulation again. It's random every time. Now
There we go.
That's much better. Okay, so we win 56% of the time with this one. And it's random every time. Over on the right, what Kurt was referring to is we won the first time, lost the second time, 2 wins in a row, and then a couple of losses in a row, a couple win, loss, loss, win. So it's random every time. But overall, we had 56 wins, lost 44% of the time. It's a winning track record. We took the high up to about $25,000 and a little bit over $25,000. But at one point, we still suffered a drawdown of about 26%. But if we hung in there over those 100 trades, we stuck out that 26% drawdown, still ended up essentially doubling our money.
Mike, I'm writing this down. There's 56 winners in that trading record.
Yes.
56 winners.
Mm-hmm.
And we had a low value of $74.74, an ending amount of $20,168.
Okay.
All right.
Now,
so let's change what we can change.
Yeah, this is winning more than we are losing. So go ahead,
Right.
Kurt.
Oh, I was going to say, let's change that target return. And in fact, instead of raising it, which, sometimes I ask folks, hey, would it help if your winners won bigger? And of course it would. But what if we couldn't do that? What if we just made our target return a little more modest, say 8%?
Okay.
Okay. And but we did something drastic to our loss limit. We changed it to 4%. Okay.
Oh.
Not 43%. That'd run our whole day. All right, so 4%. Okay. Now let's run that simulation again and see what happens.
Hey.
Now that's a little different. Mike, we're actually losing more often than winning in this particular scenario.
46 winners. 46% winners.
Look at that drawdown. Is that a precipitous fall from 10,000 to 9,953?
No, it's less than 1%, isn't it, Kurt?
That's the biggest drawdown that we had in that record.
Mm-hmm.
Interesting. And then ending amount is nearly double what we had. Now, Mike, did we? Let's just review this. Did we raise the target return?
No, we lowered it from 10% down to 8%, so we have a lower expectation of profit.
So that's weird. And did we win as many times?
No, we
No.
lost a lot more.
Yeah, we had 56 winners in the 10% target return, 10% loss limit portfolio there. We had 56 winners and made the account into 20,000. Here we had only 46 winners, 54 losses, and took the $10,000 up to 38 grand. Now, folks, it's important that I emphasize something. I am not trying to project returns here. What I'm doing is just saying that, hey, with that probability of a loss of being equal, and even with trade records that are a little bit disparate, and instead of one that wins more often, we have one that loses more often than it wins here, but it's still making money. It's because of the skew that we've put into it by keeping our losses down very low at the low end of that Martingale curve.
And it's not only
Pretty
that.
cool.
It's the only thing we can control. I can't control how many times I'm going to be right. I can do all my due diligence, but I can't control what the market's going to do. She's going to do what she wants to do. And I can't control how much profit I'm going to make. I can set a goal that I'll close a position if I make 7, 6, 8%, 10%, but I can't control how much I'm going to be right when I am right. The only thing I can control in the market is how much I'm willing to risk. Now, Larry jumped in a quick question. I know we're going to get to this later in the presentation. We'll address it a little bit, but Larry wanted to know, would you close the position at 4% loss? Well, that's the great thing about this approach. If the market pulled back, once I opened one of these RPMs, once I opened a radioactive profit machine, if it pulled back and I had a 4% loss, and maybe my maximum was still 6%, I can choose to take my money off the table and only have that 4% loss, or if I think the market's going to recover, I can stay in the position knowing I'm still not risking more than 6% and then still realize further upside. So I could, but I have the choice. I have the power to decide. It's not like a stop loss or a market order that closes me out. I have the choice to stay in and reap further benefits if it comes back up, or just close it and move on to the next position.
Mike, let's show people exactly how to do that.
Let's go. You want to take the screen back from me, sir?
I will do it.
Very good.
Very good. Okay, so we should see the hammer there, right?
It is hammer time, yes, sir.
It's hammer time. So anybody that wants to, you can go to radioactivetraining.com and play with that trade simulator tool. It is free. Okay, so here's what I call the 5 lines. Okay, the 5 lines are, first of all, ownership of stock. Okay, the cost basis of the stock. Secondly, the put option. Now, this was put together on March 11, 2011. It's actually still active. I'm no longer holding an August $65 put. It's now a November put and a different strike price. But Humana now is at a place where it's bulletproof. Well, out of those first 2 lines, if we add them together, the cost for the stock and the cost for the put, we have $69.70 invested. But I've got a guaranteed exit of $65, right? I mean, even if the stock crashes, even if the stock market crashes, we have a big problem out there in the market. I can't get hurt by a finicky stop loss order.
That's right.
This $4.70 difference is all that's at risk. And Mike, just as you were alluding earlier, if this is a position I'm putting together in March, and it's 5 months out in time, it's August time frame when the put expires. Even if the stock crashed, I would probably not lose that whole 6.7%, would I?
No, because in that first couple of weeks or the first couple of days, if it collapsed, you would still have time value remaining on that put option. This full at-risk amount assumes that the stock was still trading below $65 all the way to August expiration, and you made no adjustments during that 5-month time frame.
Right, and I'm in control of 2 of those 3 factors. I'm not in control of what the stock does, but I'm in control of whether or not I do an adjustment, and I'm in control of whether or not I hold it all the way until August expiration. Okay, now this is scalable. If you're a big fish, you don't have to do 100 shares, risking $4.70 each. You could do 200 shares, risking $4.70 each. All you would have to do then is buy 2 put options. If you had 1,000 shares, Mike, how many put options?
Well, I'd buy 10. I'd keep it a 1-to-1 risk-reward ratio.
Right, but you would still have only 6.7% of your invested capital at risk. And I want to point this out, Mike. This is 6.7%, or I'm going to just say 6%, because like I said, there's quite a bit of time left until expiration, and I can make my decision in the very near term to get out if the stock is going against me. Okay, but if I'm trading $100,000, if I do 200 shares and 2 puts, that'd be $940 total at risk. So within that trade, 6%-ish, right? But out of the portfolio, only a little less than 1%. Okay. All right. Cool. Now, before we show what that's all about, okay, before we show what we can do with that, okay, let's do a quick poll here, Mike. I'm going to say, if you kept your wins from last year, but losses in individual trades was kept to 6% or less, and that risk represented only 1% of your portfolio, okay, how much different would your results be from last year? And keep in mind, all I'm showing is a setup. I haven't even shown the riskless spread trades that we're going to show. Okay, but how different, or would they be different? But how different would your results be from last year? We had 5% say, "Wow, I'm ecstatic." Great year in 2010. Things are looking good in 2011. And we had 27%, well, I was happy, but I could stand to be happier. So that's 32% that were happy with their trading results. 68% were not. Let's see what the difference is now. and close. I'm going to close that poll. Sorry if you didn't get a chance to vote. We do need to try and keep these things moving quickly. Okay, Mike, 56% would have said yes, I'm very happy. How many were in that category before? Was it 5?
5%, yes, that's right.
About 5%. Now we got 56% saying yes, I'm very happy. 16% said no or mixed emotions but would have been happy. 8% had a losing year, but this would have put them over to a winning year. And 20% would have still lost, but they would have lost much less, so that at least they wouldn't have gotten hurt too badly. Nobody said, hey, you know what, Kurt, honestly, I never had a loss over 6%, and I still lost overall. Nobody said that. I wonder how many of us are thinking, let's start yesterday. Mike, what's this popular saying? It goes like this: cut your loser short, and then what's the rest? I put a few up there. Cut your losers short. And what's the rest there, folks? Somebody said, and don't spit in the wind.
Well, that's good advice, but is the second one there, is that Macbeth, or is that it's from Macbeth, isn't it?
Yeah, and all that glitters is not gold. That's from Shakespeare too.
Oh, right.
That's all from Shakespeare. Yep. All right, let's give it another few seconds here. Okay, we got a couple of wise guys, you know. Everybody got it. Okay, let your winners run. Okay, cut your losers short and let your winners run. Okay, well, yeah. You know, when I first heard that, I said, well, I'll just do that. Okay. Let me ask you something, Mike. Does the strategy of selling covered calls or selling naked puts go well with that phrase?
Well, no, it's kind of opposite, isn't it, Kurt?
Yeah, it's kind of backwards. What about this? What about vertical spreads, like a bull call spread? If you're right on a bull call spread, and that's, say you buy a $50 call and you sell a $55 call against, you know, to mitigate your cost, you're going to win if the stock goes to 55, right?
Well, sure.
Are you going to win more if the stock goes to 70?
No, I had a capped gain on the position. I had a maximum profit that could be achieved without making an adjustment or editing the position. It could go up to 100, Kurt. I'm still going to make the same profit.
Oh, boy. Okay. All right. So what about these things that fly, you know, the butterflies and the condors and so forth? You know, do they let winners run?
Well, no. In fact, you don't want the stock to go anywhere with a butterfly or a condor. You want it to stay right at the same price. You don't want a runner up or a runner down, as you might with a bear call spread or a long put position by itself, I should say. So your neutral position, you want the stock to stay the same.
That's right. Condors capitalize on the fact that the market is usually moving sideways. I mean, it's trending up or down a lot of times, but usually it's just kind of sliding along sideways. But you can't possibly let your winners run, okay? And Mike, I looked at this propaganda. You know, this is from my broker. All right, my make you what?
Make you broker, right?
Okay, and it certainly is a bullish strategy to do a cover call because most of what's in a cover call is you owning stock, and that's bullish. If that's not bullish, then you're being silly. You want to buy a stock that you think is going to go up, right?
Yes.
I take issue with them saying that it's safer. I don't think that necessarily cover calls is safer. In fact, I've got all kinds of evidence to say that a Mary put is much more safe. But I will go along with this, that the reward is limited. In a spread trade, we do dial in a loss limit, but it doesn't still follow that saying. You know, cut your losers short, yeah. Let your winners run? No. Most spread trades don't let your winners run.
And the problem with this live leverage on the spread trade is that if you're entering it correctly, looking for a higher probability being further out of the money, you're cutting your winners short. Sure, you have a maximum risk, but the maximum risk is usually 5 to 1 or 10 to 1 against the potential profit. So if you've one bad trade, you could wipe out 8 to 10 previous trades in a spread portfolio, and that's where it comes back to haunt you.
That's right. We're not saying anything different to our spread traders. They know this. But how would you like to? I'm going to show folks how to do a bear call spread trade with zero risk. Would that be cool to know?
Yeah.
Yeah. It takes a credit to open it. You know, you get paid to open it, but you can't get hurt. Ooh, what? Okay, let's see if that's possible. Mike, along the way, I got this idea that if I was going to be bullish on a stock and I want it to be safe, I'd still like for my risk to be unlimited. And that I believe is congruent with the cut the losers, let the winners run. And so far, I have not been proven wrong. Okay, so let's show these riskless spread trades. I think that's what a lot of folks were wanting to sign on today for. Okay, I call this one taking back the edge because Mike, when you buy stock, you're gonna lose a few cents on the bid-ask spread, right?
That's right. Hello?
Yeah.
Okay.
For example, the stock might be selling at it might be selling at $60.05, right? To you, but the on the bid it's $60. You know, so there's a nickel spread there, or maybe there's a 20-cent spread between the bid and the ask on the put. Okay, so if when you buy your stock and buy your put, you're going to have a bit of a setback. Well, this will reverse that. Okay. Here's an adjustment. I call them nested spread trades, and I also call them income methods because they're almost always done at a credit. Sometimes our spread trades can be done to guarantee a higher payout. But let's review this position. Okay, we've got Humana shares at $63.90, an August 2011 $65 put. The total invested is $69.70, but I'm guaranteed the privilege to get out at $65 even if the stock crashes. Okay, so my maximum at risk is $470 or 6.7% trade. Okay, and remember that's scalable. So if we have 200 shares and 2 puts, then that would be $940. And here's the graph of that. Okay, $940 at risk, 6.7% of capital in the trade at risk. And what's the really happy part about this?
Well, we're letting the winners run. We have the potential for an unlimited upside profit.
That's right. Okay, now let's introduce a different trade. That one just clearly showed the 2 protected puts plus 200 shares, and we're risking $940. Now let's look at the bear call spread. What I had been showing was a stock plus an August put. But remember, this is March that I'm putting it together, and in March I'm selling an April call at 95 cents and buying an April, oh gosh, you know what? I didn't correct that. It says $75 call. It should say $70 call. Sorry, Mike, I'm going to have to fix that. An April $70 call at 45 cents. So the difference there is a credit per spread of 50 cents. Now, if I've got 200 shares, I'm going to do this twice. I'm going to do 2 spreads. Here's how it's going to look. I get paid on the front end, don't I?
Yes, you get 50 cents per contract. You did 2 contracts. You collect $100 total net credit into your account.
Right, but the width of that spread is $2.50. Yeah, there's 67.50 calls here and $70 calls there, and the $70 calls kind of insure me so that if the stock goes up really high, I don't ever have to pay more than $70 for the stock, right? But I do have to deliver on this 67.50, this short call here. Okay, so the problem is when I do this, I receive $100 on the front end, but I could have to pay $2.50 twice, or $500 total. So the maximum I could lose with this is what?
Well, it's $400 because you keep the $100 credit no matter what happens. In the worst case scenario, you'd be risking $4.
That's right. Okay. Now, let's go ahead and see what happens if we nest them. Okay, and nesting. What I mean by nesting is placing one trade within another. Our radioactive profit machine had $940 risk, right?
Yes, the 200 shares and the 2 puts.
Right, and the income method number 6 trade that I just showed, which is a bear call spread done in the context of a Mary put. Well, the income method number 6 trade by itself has got $400 risk. Okay, so if we add them together, how much risk do we have total?
Well, if I just added the total risk, it'd come up to $1340, but that's not how a nested spread trade works against an RPM, is it, Kurt?
That's right. In this case, the 940 at risk plus the 400 at risk does not equal 1340. Okay? If that bear call spread ends up costing me the maximum $400, well, the only reason that it cost me that is that the stock went up, right?
Mm-hmm. That's right.
And I own the stock. The stock that I own has to go up by more than that. Cancel the loss. Take a look at this, Mike. If that bear call spread closes against you, the stock more than covers your loss. You cannot lose without winning. This is the position, all four legs. We've got the stock,
Mm-hmm.
plus the long-term put, plus the near-term short call and the near-term long call. In fact, Mike, if the stock goes up above 70, that's a good thing, right?
Oh, yeah. I mean, we haven't capped the upside. We did sell a call. We haven't capped the upside gain on the position, so we can still realize further profits as the stock continues to move.
Right. So it had been, for owning this stock and protecting it, it had been 6.7% risk, but now it's 6.1. It had been $940 maximum risk, but then we collected $100 for putting on those spreads, right?
Mm-hmm.
And so that reduces the cost basis of the stock. It reduces it by $100. And if the stock goes up, well, that's a happy thing. We don't care. That's kind of cool. So, Mike, in the context of my stock plus a put option, in the context of that, is that bear call spread risky?
No, not at all.
No, I mean, there's no risk. I'm taking a credit, but if it goes against me, so what? It means I win. Okay, kind of cool. All right, so there's that. That's wonderful. Done correctly. Now you have to do this correctly. If you do this at the wrong strikes or with the wrong emphasis on time, you know, for example, I showed this with April calls and August puts and so forth. You got to do this correctly, but it introduces no risks, though it does take a credit. It's nested within the married put. That bear call spread can only take a loss if I win, and I have to win bigger. Does that make sense?
That's right.
Now, to see if my radioactive profit machine is a candidate for income method number 6, I use the Power Options tools at www.powerup.com/RAT. If you click on that, I don't know if you can click on that, but Mike, you sent out a link earlier, right?
I did. That's correct, sir.
Yeah. If you check your chat box, you should see that link. If you want to pick up 2 weeks free, go ahead and click on that, and Mike can walk you through the tools. Okay? I use the custom spread tool in the trading platform to confirm that my bear call spread idea has no risk. And here's how: by entering all four legs, and then checking the graph to see that the dip caused by the bear call spread still ends up above the break-even line.
Mm-hmm.
And if it does, then that is a candidate for income method number 6. Okay? All right, we're going to take a couple of questions, and then I'd like to launch into another one or maybe even 2 other riskless spread trades. We've got prepared for 2, but we're running short on time.
Yeah, I don't think we have any questions that we haven't already answered, Kurt. We got a chance to answer the couple questions that came in already in the presentation, and oh, okay. Well, Arnie asks, well, how come you don't discuss exit strategies? This is extremely important in any trade. Well, Arnie, you know, we do. we're just not showing it yet on this one, but in different webinars we show adjusting the different income methods. And really, Kurt gives away more for free than probably any other guru I've seen that has a product, that has a description. And the full management techniques, the discussion of the management techniques is all in the blueprint. We're showing you what's possible. We're showing you what you can do and some of the different adjustments that can be made. And sometimes during these webinars we show the adjustments that can be done in a bullish, if the stock moves up after you've entered the RPM, if the stock moves down after you've entered the RPM, or if the stock stagnates. But we're not going to give away everything in the blueprint during the presentations. But it is discussed, and a couple webinars that are archived there, Kurt discusses how he adjusts the exit strategies for if he has an income method number 5 open, if he has an income method number 6 open. He's shown some of that as well. So that is shown. It's just not always discussed during these different presentations because Kurt wants to introduce the 3 income methods for those particular strategies he's referring to.
Right. What was that fellow's name again?
That was Arnie.
Arnie, I have to agree that the exit strategy is the most important component of any trading. But one of the things that we're doing, there's 2 different exits, right? There's the exit at a loss and there's the exit at a profit.
Mm-hmm.
And we're controlling absolutely the exit at a loss. In fact, right now I'm going to show bulletproofing, where you take all the risk out. That's kind of cool. I like to say that income method number 6, the one that we just did, takes back the market maker's edge, because that 20 to 25 cent edge that he has against you, well, that just got flipped with a 50-cent credit, didn't it? Okay.
Mm-hmm.
And by the way, because that put option is so much further out in expiration than the near call spreads are, you could possibly do income method number 6 repetitively and take out all risk. I've also had it happen, Mike, where I've done a bear call spread and my stock has gone down. With General Mills, for example, my stock went down 11%. I had stock, I had a put option protecting it, and I also did a bear call spread to take income. General Mills goes down 11% below my cost base. I said, okay, I'm ending this trade, but guess what? The amount that the put went up, coupled with the premium that I captured with income 6, guess what? I ended up making money. I made money even though the stock went down, and I was bullish. That's kind of weird. Okay. All right. Now, sometimes I like to speed things up again. We're going to show income method number 4, another riskless spread trade. We're going to do it on the same stock. Normally, Mike, and I'm going to ask everybody out there in the audience, maybe you can come up with this real quick. If you sold a lower strike price put and simultaneously bought a higher strike price put, what would you call that spread? We've got a bunch of spread traders online, so let's see who can answer that one first.
Yeah, if I saw, okay. Okay. Yeah. What's that?
Did a lot of people write in already?
No, I'm a little bit behind, so it's just okay.
Bear put spread, is that what we said?
Mm-hmm.
Okay.
Yeah.
That's correct. Okay, now a bear put spread has risk, yes?
That's right, sure. We saw that before with the vertical spreads. Mm-hmm.
Okay. Well, I'm going to show we're doing the bear put spread in the context of the married put. In some circumstances, it represents erasing risk. Okay. Some folks object to spending money on that put option, like you did at first, Mike. You looked at that and said, Kurt, I don't know how you're going to make any money. But then after I show you how to nest spread trades within it, then you said, man, this is worth a try. and then you learned about bulletproofing and keeping your stocks with very, very low risk at first, and then after that having no risk. And when you have no risk, man, you're kind of like that guy on the trampoline, you know, that's not just jumping with the bear trampoline there. You've got the harness, you know, you can't get hurt. Well, dude, that releases the high performer within. What if you could use this put as a dynamic hedge? There's no risk in the context of the married put. If I was to buy to open the August $70 put for $6.90 and sell to what? Close the August $65 put for $4.10. Remember, I already own that put option when I'm playing Humana in the married put. Now this is a total debit. That's how much I'm going to pay for this bear put spread. I'm going to pay $2.80. But what has it done? It has raised my minimum payout by $5. And where I come from, trading $2.80 for $5 is a good. Here at the bottom, this is where I started with the shares at $63.90 and the put option at $5.80. Now later on, the stock has gone up 7 points. When it goes up 7 points, my put goes down by $1.70. Do you see that? Right here, it's $5.80. And then it got lowered down here to $4.10. Here I am selling it, and in its place buying the 70 puts. Okay, and Mike, what's that done to the at-risk picture? Is it 940 anymore?
No, we've lowered that back down because we did put more money into the position. And MG, this answers your question from earlier about rolling the put there. Excuse me, about rolling the put there. But yeah, it's you've moved it up. You paid to do it, but you're getting a higher payout.
Right. My maximum risk is now 500 instead of 940, so I've cut my risk almost in half. Okay. Maximum risk is 3.4%. Still have an infinite upside profit potential. Okay. Now, I know what some of you may be thinking. You may be thinking, well, Kurt, you didn't take into consideration that bear call spread. Okay, what I've done here is take my at-risk amount in the married put from this level down this level. There's less risk. Okay, but as far as the bear call spread, well, that's still in place. So now I've got all the legs here, and now we see the maximum risk at 410. We see the maximum at-risk amount at 2.8. Okay, and if the stock goes up, well, we don't care. If the stock goes up, two things can happen. One, we could lose our maximum amount on the bear call spread, and bam, this is April, and my stock is insured out to August. I would at this point be bulletproof. And if the stock goes higher than 70, which at this point it was,
Right.
I'm going into bulletproof status already. Now, just so you know, I did have to buy to close this bear call spread, but I used some other income methods, and guess what? Humana is now completely bulletproof all the way out to November. I cannot get hurt. In the meantime, I am collecting dividends, and I can do other nested spread trades that'll collect more. The income methods reduce the gap between the break-even line, okay, and the maximum loss. Now, you can do them repetitively or combine them one with another, and at a certain point, enjoy being completely risk-free. It's what we call bulletproof. Kind of cool. After you're bulletproof, you have no worries, but you can still continue to do income methods to take credits, or you can just allow your stock to go up, or you can do both. Bulletproof means no worries. Okay? All right. Now, Mike, I don't know if we've got time to show these. In fact, I'm gonna say that we certainly don't have time to show these. But I'll just mention my Marvel trade. I was able to hold Marvel for 2 months and have 30.2% return. The remarkable part about it is that during that time I also took income out by way of income method number 6, a bear call spread. The stock blew its doors, and of course, I still had an unlimited upside, so it's kind of cool. You with your SLW trade, Mike, in your first month of that trade, you could only possibly have lost 7% of the capital that you dropped in there.
That's right.
SLW is a very volatile stock, and maybe trying to follow it with a stop loss order of 7% would not be the best way to go. But what you did was you had only 7% risk, and then in the middle of that, you got bulletproof to where you had no risk, and then finally a nearly 60% gain, and that's pretty good. Okay. McDonald's, we had one of our subscribers write in. See, this is me, this is Mike, and this is one of our subscribers. One of our subscribers wrote in and says, hey, I own McDonald's stock, and I'd like to bulletproof it, but I don't want to pay for insurance. And I said, well, guess what? There's a way for you to completely pay for your insurance right out of the gate, and I showed him that. I'm not going to get to show that to you guys right now, but it is available to Blueprint owners. Okay? All right. So, riskless spread trades, part 3, double dipping. I'm going to take a moment and show this. Once you have bulletproof to stock, and there are many ways to do it, you can do a lot of things. Okay? You can end it. When you have 0% at risk, it does not mean 0% profit. 0% risk just means if something catastrophic happens to the stock, you can't lose. But generally speaking, when you're bulletproof, your stock plus your put equal more than the cost basis of what it took you to get into it. Okay, so you can end it. You and I, Mike, you and I ended one 8 days in for 15% profit. Remember Green Mountain Coffee Roasters?
Yes.
Yeah.
It was
I got
8
into
days.
200.
Yeah.
Yeah, I got into 200 shares. You got into 100 shares. We held it for 8 days, and we liquidated for 15% profit in 8 days. Pretty cool. But the really impressive part was we only could possibly have lost single digits going in. Another thing is you could hold it. Who says you need to do anything? If that stock is on a run, remember, it's cut your losers short and let your winners run. But here's another thing you could do. You could play it further with other income methods. Now, this last one, not everybody's going to catch. Not everybody's going to catch this, okay? But it's kind of cool. Okay, I'm going to show a different stock than Humana. Lulu, I was able to do a couple of income methods on and so forth. I end up with Lulu at a total cost basis of $85.19 for 200 shares of Lulu and 2 June $80 put options. Okay, so here I did income method 4, right? Where I swapped the $90 puts for the $80 puts, and I spent $5 to do it. Okay, so here's what that looks like. I'm starting with 6% risk, or 6.1% risk, and end up with almost no risk, 0.2% risk. Now, in the context of it, here's the riskless nested spread trade move. Okay, I said I was going to show 3 different ones. I call this one the money net because it takes a credit to do it in the first place, and it could possibly bring in more. It's not a certainty, but it could bring in more, but there's no risk ever to your capital. And you're going to need power options to check this out. Okay, www.powerop.com/RAT. Okay, income method number 1 is to buy 1 call and sell 2. Now, Mike, normally, if I was to buy one $85 call for $560 and sell 2 April $90 calls for $290, that would indeed generate a credit, right? The $290 premium times 2 is $580, and the premium paid is $560. But normally that's a problem. What's the problem here?
Well, you did generate a credit of 20 cents, but now you've got sort of a naked call sitting there. You've got 2 short options and 1 long option, so you've essentially got a bull call debit spread and 1 naked call, which has infinite risk on the upside.
Yeah, not cool. Here's the deal. I'm receiving a small credit to put this trade on. Okay, and if the stock goes up, well, geez, you know, those $90 calls, if it closes on this side, those $90 calls are going to expire worthless, but that $85 call is going to be worth something, right?
Yes.
What could happen is the stock could close right at 90. Those $90 calls expire worthless, and the $85 call is worth $5. Okay, so that's why I call it the money net. It catches money. Now here's the problem. As the stock goes up above 90, we're on our down slope coming back down. Okay, and if that stock went all the way to 100, man, we're losing money fast, real fast. It goes to 105, we're losing money super fast because we have a naked call. But remember, yeah, do you see trouble brewing as the stock climbs? Remember though that this is done in the context of American. Okay, by buying one $85 call and selling 290s, it's almost like I bought a bull call spread, you know, 1 long $85 call and 1 short $9 call, and financed it by selling a covered call at the $9 strike. And that's what's going on here. Now, Lulu went to $93 a share. This is a real trade that I did. Lulu went to $93 a share. So, Mike, I had to buy to close one of those calls to keep my stock from getting assigned. So I buy to close the April 90 for $350. How much did I receive on the front end for doing this?
It was 20 cents, right?
Right. Okay. So my total spent is $3.30, but I get to keep my stock, and it's up. And I know that sounds like, well, Kurt, you know, why would you do that? You know, you're spending $3.30, and I don't understand. Well, looky, that bull call spread is going to close in the money. The bull call spread is left over. See, I've still got a long 85 and a short 90. In the middle of the night, my broker says, okay, Kurt's got the right to buy these shares at 85, and he does it on my behalf using automatic exercise. And then he also says, hey, Kurt needs to deliver these shares at 90, and he does that on my behalf using automatic assignment. And so the $5 difference I capture. Now here's the deal. The really exciting part is I've paid $3.30 for the privilege to manage and capture the $5.
Right.
So I capture $1.70. Mike, if I sold a plain vanilla covered call, I'd have to deliver my stock at 90, or I'd have to pay more than I took in to keep it. In this case, I'm getting paid to keep it, and the stock is up. Try that with a covered call. You see, you know, Lulu went up even further. I got paid on the front end, and then I got paid again to management. And so the Lulu shares had been trading at 88.65. So when they were trading above 93, the stock goes up by more than $4. I get that $4 capital gain, right?
That's right.
Yeah, and I also get paid $1.70 for the of holding on to it. So kind of cool. Here it is again. Total spend is $3.30. The bull call spread brings in 5. So I've been paid $1.70 to sit on a stock that goes up even higher. I've captured part of this premium here in what's called the money net, and never had any risk. And here's why I say that I never had any risk. Remember, we bulletproofed Lulu. After bulletproofing Lulu, we can't lose on the stock going down, right?
Mm-hmm.
Okay, and then we accepted 20 cents on the front end. But this is what happened to the chart. When I did the ratio call spread, see this accelerated zone here? What's missing from this chart, first of all?
Well, there's no break even. It never drops into the loss area.
Right. Can't lose. But as the stock goes up, what happens is it kind of accelerates between 85 and 90 because of that ratio call spread. Okay, so as the stock is going up, the capital value of the stock that I own is going up, and also as the stock is going up, the long call is gaining in value, and the $90 calls, the time value is decaying rapidly until it finally has to go to 0. Okay, so that's kind of an exciting thing to me, is to show folks how you can do a ratio call spread, which normally has infinite risk, and make it actually be on your side, where it takes money. If something goes absolutely totally wrong, well, you keep the money from that. If it closes between the strikes, you capture more, and if it closes above, well, you still capture more. It's kind of cool. Okay, Mike, let's see if there's any questions at this point. And while it's going on, I wanted to ask a couple here. Okay, so what 2 things did you like the most about radioactive trading? We've only shown, out of the 10 income methods, we've shown 3. Do you like the idea of starting with very low risk in case you're wrong in the first place? Do you like the idea that you can adjust your risk and take income on the fly as you go? Do you like the possibility of being bulletproof to where you can't possibly lose, but you don't have to necessarily get out? You can still let your stock ride if the market is being good to you. How about the idea of taking income by way of spread trades that don't introduce any risk? Or the fact that there's 10 total income methods rather than the 3 that I shared today for different markets. Okay, we're going to leave that up for another few seconds. Mike, any questions come through that we can...
Well, they were all great questions. Unfortunately, I've probably answered about 12 to 15 of them, so I don't know which ones are the best ones to share with the audience. Answering one from Mary right now: how do you determine the optimal put strike to bulletproof your stock holdings? Well, it really comes down to what's discussed in the blueprint on the SIGA model. We use the Power Options tools to identify the positions based on the principles in the blueprint. There is such a thing as going too deep in the money, taking too little of a risk, and taking too high of a risk as well. But it does boil down to your expectations, Mary, and your personal risk threshold. Kurt and I can look at the same exact stock. And we could look at Lulu right now if we both wanted to open it and pay into the position, and he and I might select different strike prices with a different month. We're still going to follow the basic rules in the blueprint. We're going to be at least 5 months out in time. We're going to keep our risks to 3.5 to 9%. But in the end of all things, Kurt might decide to take a slightly higher risk, not go as deep in the money. I might be more conservative. It really comes down to your personal risk threshold.
Very good. Mike, I put up another poll there. I asked, what do you want to know more about next? And, yeah, that's populating pretty quickly. And looks like a lot of folks would like to hear the offer for the blueprint, but a lot of others would actually already have the blueprint, would like to know what to do next. I'm going to say 2 things. Number 1, support. Part of your blueprint purchase, when you got the blueprint, part of your purchase was that you got email support. So any concept or idea that's in the blueprint that you didn't get, go ahead and write to us and ask whatever questions you've got and how to apply it. We're very pleased to do that. And then the next step I would say is get yourself a Fusion subscription. Fusion is what we're doing right now to merge some of the search capabilities of Power Options. Although right now Power Options is a better way to go. Fusion is a way that you can look over my shoulder, look over Ernie's shoulder, look at what kind of trades we're making or how we're responding to the market. And also we're putting together an ongoing list of lessons, multimedia, to take you by the hand and walk you through how to do this stuff. Okay? All right, I didn't close that poll. Let me close that poll. Okay, I'm going to do a final deal here, Mike. We already showed the results to this. We had, looking back over the last 12 months, okay, this is what the results were before I showed the setup, right? After I showed the setup, instead of 5% being happy with your trading, we had 56% saying I would have said, yes, I'm very happy with my trading. 16% would have said, had said no or mixed emotions, but would have said, yes, I'm happy. 8% had a losing year, but this would have made it a winning year. And 20% would have still lost, but lost much less. Well, I'm going to ask you to put a dollar amount to that, okay? How much better would you have done? How much better would you have done? This will be our final poll. And, of course, we're going to show how to pick up the blueprint, because that was another question that was asked. Okay. Cool, folks. Okay. Let me go ahead and close that poll and share the results. This is pretty amazing. All right. Mike, I don't know if you can see that nobody said, I don't get it. Nobody said, well, I can't see how it would even help you at all to prevent yourself from losing too much. Okay, so everybody got that. 5% would have saved at least $350 on the worst trade. I picked that amount because over here on the products page is the blueprint. It's $339 for the blueprint and $11 shipping. Okay, so that's why I picked that number, $350, because that's what it'll cost you to get the blueprint if you live in the continental United States. Okay, 32% would be ahead by $1,000 to $5,000. Look, that's just on the setup. Remember, I did this poll before I showed the riskless spread trades. That's just the setup. That's just keeping yourself out of trouble. Okay, 26% between $5,000 and $10,000, and the largest result. This information would have made $10,000 worth of difference to you. Okay, so I've got a question. The question is, when do you want to start doing this? Here's a better question. If I did this poll a year from today, what would you say about your year's trading results? Would you say happy, unhappy, mixed emotions? The very best part about this offer here for the blueprint, if you haven't already picked it up, besides the bonuses, the bonus for $10 fishing, or the Foundations of Radioactive Trading CD, which will teach you how to manage multiple positions and allocate your assets properly. Okay, the free month of Power Options. The best thing is this guarantee, because what it does is it takes the risk out. You see, if you were to look at this blueprint as a married put trade, you'd say, well, you know what, I'm getting in, and there's no telling how much I could make. It's an unlimited upside potential. But if I'm wrong about it, if the blueprint is not what it's cracked up to be, well, gosh, I'm going to lose $339.
Mm-hmm.
Okay. Mike, what if we took out all the risks? That would be a bulletproof trade, wouldn't it?
That's right.
I mean, if we said, if we said, look, your satisfaction is guaranteed. If you're not happy with the blueprint, send her back. Send her back, and we'll send it. We'll send you a complete refund. Okay. So there's that. Okay, Mike, we're 10 minutes over. I think that it was important, though. 9 minutes, or I think it was important though to get that last spread trade in there, because we did promise it in the email. So, any other feedback? I know that you've gotten a lot of.
I don't know if we're gonna. I think it's all covered. If you have any other questions, just send them to support@radioactivetrading.com. I'm going to answer one or two more. I'm sure these questions are all great questions, but we just don't have the time to go through all of them now, unfortunately, since we're already over time. So if you have any other questions, you can just send them to support@radioactivetrading.com, and either Kurt or myself will take care of them.
Yeah, questions are good. I'm so excited that you're excited. That's marvelous. And some of these questions are like, wow, how do I get this? Other questions are going to be full of skepticism, and that's cool. You should be a skeptic.
Mm-hmm.
You should especially be a skeptic if you've been taken in by this 3% per month, 6% per month thing that the Covered Call Guru has told you about. Okay. What are some of those questions there, Mike, that we can handle for folks right now?
I'm sorry, Kurt. I'm really sorry. There were too many questions that came in. I can't really go back in my mind and just, I'm trying to answer them rapid fire here. So MG says, great presentation.
Thanks, MG.
Richard, what happens outside the continental U.S.? I don't know what that's.
Shipping is $41,
mm-hmm.
Richard, outside the continental U.S.
Okay.
Okay. Mary says, terrific webinar, great information. Thanks. You are welcome, Mary. RI says, let's say we have volatility. What is your meds here? I don't understand that question.
Yeah, Patrick here. We've had
all married puts.
Yeah, Patrick and I have had an ongoing conversation about how can you lose on the position. We sort of showed that already. If the stock falls immediately, it just collapses to zero. Hey, you might lose 6%. Also mentioned, well, if the stock stagnates and you do nothing, well, you could lose on the position as well. You can enter the income methods incorrectly. That's another way to lose with this technique. If you've watched this presentation, you say, okay, I see what Kurt's doing. He's buying a put 5 months out. He's doing this. And, well, I'll tell you what, I'm going to do that too, and then I know covered calls, so I'm going to sell a call right away. Well, that can increase your risk on the upside in the direction that you thought you were doing it. And then Patrick, of course, the follow-up is, well, I don't understand this now. I know Kurt's taken some losses, but if he's doing all these income methods and he does them perfectly, how can you lose on any trade? Well, sometimes the stock just doesn't do what you expect. And it's okay to get out of the position, take the 2-3% loss, or maybe even a 1% loss, Kurt. You had a stock that dropped 11%, and you only suffered a 1% or 0.5% loss on it. It's okay to take that loss and move into a new position.
Yeah, Patrick, I don't claim not to ever lose. In fact, if you look at my trading record, I have more losses than wins. I just make money. I have more losses than wins, but I make money, and the reason is that I don't take big losses, and that is the point of RadioActive trading, is control your losses to very small, single-digit amounts from the beginning.
Mm-hmm.
Sam says, before I consider joining, where can I back test some past examples? You can see my track record and the track record of other RadioActive traders on RadioActiveTrading.com, and also with that link, www.poweropt.com/RAT. That's a wonderful back testing. They have wonderful back testing tools on there.
Yeah, and another key is there, Kurt, if you go to RadioActiveTrading.com, if you haven't yet, put in your first name, last name, and email address and click Get the Sketch. This gives you a user ID and password for a free registration account at RadioActive Trading, and that will allow you to get a little bit more details on the track records. If you wanted to look at some of those, some of Kurt's trades, and you want to see how they performed, or, as Kurt mentioned, of course, that free trial of Power Options, you can run your own searches, and for 2 weeks you'll be able to back test how those performed.
Right. Let's see. Lloyd says, for your information, Lulu just split. Yes, I'm aware of that. Lloyd, I'm long. Long on Lulu. And she's still going up. It's kind of cool. Other question. Do you show the adjustments in your book? Yeah, that's what the book's about, MG.
Yeah, we answered that one here when you were talking about that. All of the management techniques, the income methods are fully discussed in the blueprint. Mm-hmm.
Yeah. Ray wants to know, why is the blue line not flat from 67.5 to 70? He's talking, of course, about the bear call spread nested within the married put. The reason it's not flat is that as the stock goes up between those two strikes, at that, just between those two strikes, I may be losing money a little bit more rapidly than I'm making it, but guess what? I've already made money. That bear call spread nested within the married put cannot lose.
Well, yeah, and there's
incorrectly.
Yeah, I answered. These are some of the ones I've already answered that you're going back through. This also is the magic of delta at expiration, and why it's not a straight line across is because you have a difference in strike prices, but magically on April expiration, you had an August put, but at April expiration, the delta of that short call automatically went to 1. So if the stock was at 70, you have the full loss technically on the short call, the 70 call has no value, your stock still has a delta of 1, but the put's still probably only around -0.6, -0.7. So at expiration, that magic of the delta of that short call going to 1, that's another reason why it doesn't go straight across.
Right. Sam wants me to repeat the power option site. I'll go ahead and put that in, poweropt.com/RAT. PowerOpt, POWEROPT.
And John has another quick question. This is a new one that came in. Since the entire system depends on picking stocks which increase in value, well, the entire system is really about proper money management and limiting your risk, not picking the right stocks. But what basis do you select the stocks you trade? Well, John Kurt discusses that in the blueprint and on the Power Options trial. When you first pull up that married put search, you can see the criteria he uses. Now, this is not, the radioactive trading technique and what is in the blueprint is not a strict set of rules of what stocks to get into. It is not only open a stock if A plus B plus C equals D over 2 or anything like that. Okay? You can use Kurt's techniques that have worked for him over the years to be successful, even at times when he's been wrong more often than right. I trade completely different stocks than Kurt does, but I apply it using these radioactive trading techniques. You can overlay this proper money management system, forcing an ideal size trade, and the 10 different income methods on top of a stock selection process that you already use. And one of the reasons I trade different stocks than Kurt is not because I think Kurt's a bad trader or anything like that, or I think that his method is worse than mine or better than mine. I think he's been more successful with picking winners overall over a long term than I have. I've had some dumb luck with 1 or 2 trades that just took off to the moon. But my portfolio size is different. Kurt showed the Lulu trade there. I didn't get into that position with him because my capital is much smaller. I didn't want to invest in that. I trade stocks usually under $40 or $35 per share, between $9 and $35, $9 and $45 per share. Kurt's traded $100 stocks. He's traded $100 ETFs. These are positions I don't follow him in because I just don't have the capital to go into that big of a position.
Yeah, I traded Google when she was around 420. So, but yeah, it's not so much a stock picking system or a trade timing system as it is a money management system. That's the thing that most folks don't address, and that if you don't address, you can get hurt.
Yeah, and Regi mentioned about the volatility thing. You know, he said it seems most of your positions are lower volatility. Well, that's right, because by the principles in the blueprints, you know, we discussed that there is such a thing as too little risk. That if you go too deep in the money with your put and you try to take only a 1 or 2% risk by going mostly intrinsic, well, you have a very low expectancy of profit. Kurt discusses, you know, the 3 bears kind of. There's such a thing as too little of a risk, too much of a risk, and then there's about just right. And normally the just right range determines that, yeah, we're not going to be doing this on biotech stocks. We're not going to be doing this on a lot of Chinese stocks. We're going to be within a range, and the Power Options tool systems filter that for us.
Very good. Okay, Mike, I think you know, we're a half hour past, and well, you know, 15 minutes past where we said we'd stop. So I guess we probably should head out. I want to thank everybody for coming. I want to thank you especially, Mike. It's always good to have a real competent and professional gentleman like yourself by my side, and by my side 1,500 miles away to bounce off of, and you know, thanks for being here.
All right, no problem. And yeah, sorry about the questions. We just had so many come in, and they were all great questions. And you know, it's just sometimes we can't repeat them all because we're already over time. So if you have any other questions, just send them over. And remember, this is archived. We'll have it hopefully posted later on this afternoon at you can go to radioactivetrading.com and just click on the free webinars and podcast link there up at the top of the screen. Hopefully it'll be up there by this afternoon.
Very good. Okay, gang, thanks for coming. Thanks again, Mike, and we'll see you all out there. Happy trading, and bye for now.